Welcome back to CPA Mastery. In this lesson we focus on the tax treatment of gifts and inheritances. The Internal Revenue Code generally excludes both gifts and inheritances from gross income for the recipient. Even though the taxpayer receives something of value, the tax law treats these transfers differently from compensation, investment income, or business income. However, the CPA exam often tests whether a transfer is truly a gift or whether it is actually payment for services. That distinction matters because gifts are generally excluded from gross income, while compensation is taxable. By the end of this lesson, you should understand how gifts and inheritances are treated for tax purposes, how to distinguish them from taxable payments, and how to work through CPA exam questions involving these rules. In this lesson we have three primary objectives. First, we will explain why gifts are generally excluded from gross income for the person receiving them. Second, we will examine inheritances and understand why property received from a decedent's estate is also generally excluded from income. Third, we will discuss how the CPA exam tests the difference between a true gift and a payment that really represents compensation. This is one of the most important practical distinctions in this area because a payment motivated by generosity is treated very differently from a payment made in exchange for services. If you can identify the reason for the transfer, you will usually be able to determine the correct tax treatment. A gift is generally a transfer of money or property made out of detached generosity, affection, respect, or similar motives. In other words, the transfer is not made because the recipient performed services or provided something of value in return. For tax purposes, the key issue is the intent of the person making the transfer. If the transfer is motivated by generosity rather than compensation, it is usually treated as a gift. This matters on the CPA exam because the facts may describe a payment without labeling it clearly. Your job is to decide whether the transfer was motivated by generosity or whether it was actually made in exchange for work or services. That distinction determines whether the item is excluded from income or taxed. Students often confuse gift tax with income tax, so it is important to separate those concepts. For the recipient, a true gift is generally excluded from gross income. That means the person receiving the gift usually does not include the amount in taxable income. However, the person making the gift may have to consider federal gift tax rules. Those gift tax rules apply to the donor, not the recipient. For reg questions focused on gross income, the main point is that a true gift is generally not taxable to the person receiving it. So when you see a gift on the exam, keep your focus on the recipient's gross income unless the question specifically shifts to gift tax issues. An inheritance is money, property, or other value received from a decedent's estate or trust after that person dies. Like gifts, inheritances are generally excluded from gross income for the recipient. This means that if a taxpayer inherits cash, securities, or other property from a relative's estate, the receipt of that inherited property is usually not taxable income. However, it is important to distinguish between the value of the inherited property itself and any income that property may generate later. For example, if inherited stock later pays dividends, those later dividends may be taxable. The inheritance itself is generally excluded, but future income earned by the inherited property may still be subject to tax. Suppose a parent gives a child $10,000 to help with living expenses or to contribute toward a down payment on a home. The child did not perform services in exchange for the money, and the payment was motivated by generosity rather than compensation. Because of that, the transfer is generally treated as a gift. For income tax purposes, the child generally does not include the $10,000 in gross income. This is a classic example of a non-taxable receipt for the recipient. On the CPA exam, family relationship facts often point toward gift treatment, especially when there is no evidence that the payment was tied to employment or services. Now consider a taxpayer who inherits stock worth $40,000 from a relative's estate. The receipt of the stock itself is generally excluded from gross income. That means the taxpayer does not report $40,000 of income simply because the stock was inherited. However, if that stock later pays dividends or is later sold at a gain, those later tax consequences must be analyzed separately. This is an important CPA exam point. The inheritance itself is generally excluded, but income generated after the inheritance is received may still be taxable under the normal rules. Here is a classic CPA exam comparison. Suppose an employer gives an employee $5,000 at year-end, and a parent separately gives a child $5,000. The tax treatment may be completely different even though the dollar amounts are the same. The payment from the employer is much more likely to be treated as compensation because it arises in an employment context and may be connected to services performed. The payment from the parent is much more likely to be treated as a gift because it is motivated by personal generosity. The exam often uses these fact patterns to test whether you can identify the true nature of a payment instead of focusing only on the amount transferred. A strong exam strategy is to ask why the transfer was made. Was the payment motivated by generosity, affection, or family relationship? Or was it made because the recipient performed services or provided value in return? That question usually points you toward the right answer. The CPA exam may try to blur the lines by presenting a payment in an employment setting but using language that sounds generous. Do not rely on labels alone. Focus on the facts. If the payment is really compensation, it is taxable. If it is a true gift, it is generally excluded from gross income. Let's wrap up the lesson. Gifts are generally excluded from gross income when they are motivated by detached generosity rather than compensation. Inheritances are also generally excluded from gross income for the recipient. The most important exam issue is distinguishing a true gift from a taxable payment for services. That means you should always focus on the reason for the transfer and the intent of the person making it. If the transfer is motivated by generosity, it is usually excluded. If it is really payment for work or services, it is usually taxable. That distinction is the heart of most CPA exam questions in this area.